Welcome back. Now, in the fourth quarter, the Altron FinTech Household Resilience Index ticked up by a marginal 1.4%. And while an increase is always welcomed, the broader picture remains bleak, with 6 of the 20 constituent indicators having remained in negative territory. The data also highlights a declining trend in the ratio of household income to debt costs, suggesting that households are buckling under the pressure of the current economic climate. Independent analyst Roelof Botha, who compiles the index, joins us with more insights around the data and the narrative it's telling about the financial resilience of households during this time. Roelof, always a pleasure. Good afternoon.
Good afternoon.
Brilliant, Roelof. Like we're saying, a marginal increase of 1.4%, but of course there's just more colour to that number, isn't there?
Unfortunately, yes. Although I suppose everybody should be grateful for any uptick in a composite indicator which gauges the financial resilience of households and the economy in general. The bottom line is that households now spend on average 9% of their disposable income on debt, servicing debt, whereas in the fourth quarter of 2021, when the Monetary Policy Committee of the Reserve Bank started with this unnecessarily restrictive monetary policy, that figure was only 6.7%. So there's been a 34% increase in the cost of servicing debt, and this is 9% of your total disposable income on average. For some people it's double, for some people it's triple. This is not a small number, and it is a cost of monetary policy. That's all it is. It's a cost of, as far as I'm concerned, erroneous monetary policy.
We must talk about the issue of debt because, of course, I really want to get some colour on the ratio of household income to debt costs. Because what that also tells us, Roelof, is just how much South Africans are spending of their income in servicing this debt.
Yes, it is true that inflation and weak economic growth, to a large extent, have also served to erode the Altron FinTech household financial resilience index, and I think everybody feels that. And I'm convinced that many viewers will know exactly what I'm talking about when I tell them that for the average bond, home loan, administered by Better Bond in South Africa, the average one, homeowners are now paying 4,000 Rand approximately per month, every month more, as a result of the higher interest rates. This is money that could have been spent in the economy. And there are millions of these people out there. If it hasn't really been necessary to raise rates because there's no demand inflation in the economy, then we are really suffering. And as a result, if you have a fixed income and you're spending 4,000 Rand a month more on your payment on your home loan, you've got less money to spend. So that ratio of disposable income to debt costs is just declining all the time.
Let's also talk about civil debt defaults, because I think that also adds to this picture here. There's, of course, being under pressure, and then there's defaulting at Roelof, and I think that's an extra layer of strain that we're able to measure there.
Yes, it's a relatively small number compared to, for instance, the credit impairments by banks. That is a more serious problem, because that is on the verge of hitting or just over 200 billion. It's a huge number, and by and large the civil debt defaults have started to recover. I think a lot of people have just given up. I suppose there have been a lot of voluntary sequestrations, etc., and it's sort of flushing its way out of the economy. But the credit impairments by banks is not going to go away immediately.
Another interesting one here is salaries to GDP ratio. Roelof, just help us explain what this measures and how it's faring and how it fared in the fourth quarter.
Yes, it's simply the total salaries in the economy, obviously expressed in real terms, divided by the GDP. And what that tells us, if that's negative, it has a negative impact on the index, because the index aims to find out as much information as possible from every conceivable source of income, including wealth, because wealth generates income like rents on property, dividends on shares, etc. If your salary GDP ratio is declining, it tells you that the economy is growing at a faster rate than salaries. So, and that's essentially not so good for households. But that's not the biggest concern. The biggest concern, as far as I'm concerned, remains the fact that private sector salaries have now, for the first time in a long while, picked up by 1.6% in real terms, but it's still, the growth is still lower, 7% lower than it was before COVID. And COVID obviously frightened a lot of people into clinging to their jobs, even if it means sacrificing increases. And of course, inflation erodes that salary from time to time.
Another interesting one, I think there were some positives to this index, and I'm keen just to touch on them. For instance, if you think of a unit trust assets during this period, as well as other of those constituent indicators, Roelof, let's touch on those as well.
Yes, the increase in unit trust assets has been quite nifty. That was out of the 20 different indicators, that was the fourth best mover in positive territory. And what that tells you is, and what we've seen now in the last couple of weeks, new record for the gold price, we've seen a fairly spectacular recovery of share prices for many of our blue chip resource stocks, who are still paying handsome dividends between 5 and even above 10% with relatively low PE ratios. So I think the South African equity market, and obviously the bond market at 10% plus, is hugely attractive to fund managers all over the world. Unfortunately, the US long-term interest rate has picked up a little bit, which means that it's made that effect a little bit more subdued. But most fund managers realize that at some point in time this year, US interest rates, the official benchmark rate, will come down, and that will benefit us. So this has been a boon for those households that actually are in a position to afford investments in unit trusts.
Well, Roelof, all we have time for today. Thank you so much for taking us through this index. That was independent analyst Roelof Botha.